There is a crash going on in the real estate market. It is not where you think it is. The residential market hasn't crashed, and in fact, it's doing pretty well. It's pretty much flat year over year, and it's showing actually a lot of signs of strength. But things look a little bit different in the multifamily market. Not as many people are familiar with what's going on in the multifamily market. Is multifamily crashing? Is it correcting? Will properties be at a discount? Today, we're going to cover it all to help you understand where we are and what to expect over the next couple of years. I'm going to talk a lot about these national level trends about multifamily pricing, and spoiler alert, they're going down. But with corrections like we're seeing in multifamily or crashes or whatever you want to call it, there also come opportunities. But the key is being able to spot which deals are complete duds and which ones are actually diamonds in the rough. The way you spot these differences is by learning to analyze deals really well. Being able to calculate the numbers on a deal, even in an era of declining prices like we are in now, is an invaluable skill. So if you agree that deal analysis is as important, maybe more important than ever, then make sure to check out BiggerPockets Pro. It's a membership that's a one-stop shop for real estate investors to give you the tools that you need, like deal analysis calculators and many other, to succeed in any type of economy. So check it out at biggerpockets.com/pro. Let's get into the multifamily market. And let me just start with a quick primer on the difference between multifamily and commercial real estate and the residential real estate market. Residential is what most people think about when they think about quote unquote the housing market. This is basically anything that's a housing unit that has 4 units or less. Anything that's 5 units or above is considered multifamily, and that falls under the broad category of commercial real estate, which also includes things like office space and retail and medical, industrial, all those different things. But in today's video, we're going to talk about that one section of commercial real estate, which is multifamily assets. And there's obviously a lot of differences between multifamily and residential. Of course, the obviously one is the function and the size. Multifamily assets are obviously bigger. But some of the more nuanced differences are what's going to be important today. First, the buyers and sellers who buy residential real estate are mostly, about 80% of them, are just people who are looking for their primary residence or a secondary home. About 20% of them are investors. When you talk about commercial real estate, 100% of them are investors. Only investors buy commercial real estate or businesses, but that's technically just investing as well. The type of people who are buying these assets and the supply and demand dynamics are just completely different. The other main difference that's really going to be important for today's video is how residential versus commercial assets are valued. So residential real estate is based on quote unquote comps, basically comparable properties. So if you were to go and buy a house in any neighborhood, the way your agent would decide what a fair market value is by looking at similar properties that have sold recently. So basically what's going on in your market and how are similar properties selling. When it comes to commercial assets like multifamily, valuations are based off 2 things. Most of the time, not everything is done this way, but the majority of commercial assets are based off 2 things: cap rates and net operating income. Cap rates do a lot of different things in real estate, but it's basically just a measure of market sentiment and how much an investor is willing to pay for a certain type of asset. Net operating income, or NOI, is the income generated by a property before paying any debt services like a loan or any capital expenditures. So those are the 2 things that matter for a conversation about multifamily, because we're going to get into each of these things. And what you need to know is how these 2 variables impact prices. So NOI, when it goes up, that typically puts upward pressure on prices. When NOI goes down, that puts downward pressure on asset values. The opposite is true for cap rates. So when cap rates go up, it puts downward pressure on values, but when cap rates go down, it puts upward pressure on values. So just remember those 2 things, because they're really important to what we're seeing in the multifamily market and what we expect to see over the next couple of years. So the first thing, and I'll just bring up this first chart to show you that cap rates have been rising and are expected to continue rising. And based on what we just said, when cap rates go up, that puts downward pressure on pricing. Over just the last year, from Q2 of 2022 to Q2 of this year, we've seen cap rates rise from 4.9% up to 5.6%. And this may not seem like a lot, but let me just give you an example to demonstrate how big of an impact this seemingly modest change would have. So now imagine that there's a property with an NOI of $100,000. If we go back to last year, go back in time to 2022 when cap rates were at 4.9%, the value of this property would be roughly $2.04 million. You get that by dividing the NOI, which in this example is $100,000, by the cap rate, which is 4.9%. Now, if you come to this year when cap rates have risen to 5.6%, if we assume the NOI has stayed the same, that property is worth now just $1.78 million. It was at $2.04 million. Now it's at $1.78 million. That is a 13% decline in property values in just 1 year. That is obviously putting a lot of downward pressure on prices. But of course, that's just one side of the equation. Remember, we have cap rates, but we also have NOI. What's going on with NOI is unfortunately not going that well either for anyone who's holding multifamily properties. If you look at this chart, a few things are going on here. First, look at the orange line, which shows that vacancies, after getting artificially low during the pandemic years, have shot back up and are now at about historical averages, but are trending sharply upward. And personally, I expect them to go up a little bit higher. The other thing that we want to talk about here is that rents have gone up. They've grown about 1%, but that is not great, right? Just over the last year, inflation has been somewhere between 3 or 4 or 5%. And so you're seeing that rent growth is not keeping up with inflation. In real inflation-adjusted terms, NOI may have declined over the last year, which is another factor that is going to put downward pressure on multifamily assets. So when you look at these two important variables that dictate property values, they are both putting downward pressure. We have NOI flat really at best, or maybe declining, and cap rates are absolutely going up. And we see that this isn't just theory. When you look at this chart, you can see that sale prices have actually come down. This chart is from CoStar, and they have their own subjective rating system, basically how good a property is based on whatever their own criteria are. But 4 and 5 stars, which are represented by the blue line here, are sort of the highest tier, highest quality properties. And you can see the slope of that decline is the biggest. You can see that high quality class A kind of properties are seeing the biggest decline in sales price per unit, whereas 3-star properties in the country as a whole are more even. My guess is that this is because there's been a lot of new construction coming online over the last year. And so there's a lot of competition for that new high quality stuff and less competition in the class B, class C area. And so that is not seeing as big of a decline right now. Overall, what we're seeing is a significant drop. I don't know, 13% declines, like that's sort of on the fence to me between you call that a correction or a crash. Either way, it is a big decline for anyone who is owning multifamily assets right now. And unfortunately, I don't think the decline is over. CoStar, if you looked at the charts I just showed you, have a forecast. And if you believe it, and listen, it's just a forecast, so we obviously know it's not going to be exactly right. But if you think even CoStar is going to be directionally correct, they believe that cap rates are going to rise up to about 6.5% by the end of 2024, so like 18 months from now. Meanwhile, over the same period, rents are only supposed to grow about 4%. So hopefully, if you're a multifamily operator, you're saying, okay, rents might go, cap rates might go up, but maybe rents will keep up. It's not looking like that, at least according to CoStar. Go back to that property that we talked about with a $100,000 NOI as our example. If everything CoStar says comes true, this means that that property would decline an additional 10%. It would go down to about $1.6 million in value, which would be more than a 20% decline from peak to trough. And to me, that is a crash. That hasn't happened. I just want to say we're at about 13% declines nationally right now. But if CoStar is correct, we'll see more than a 20% decline peak to trough, which to me would be, uncategorically a crash. So what does this mean, and what should investors do about this information? First and foremost, remember these are national trends, and every market is going to be really different and really unique. Secondly, on a broad scale, you just need to exercise caution, right? Anytime asset values are declining, you need to be a little bit more careful. Prices are already falling. There is economic uncertainty. There is stress in the banking sector, especially in commercial real estate banks. So you probably want to be really careful about anything that you buy. But as anyone who's been in real estate or even the stock market knows, a lot of the times when there's these corrections or crashes, there are going to be deals. You just kind of have to sift through a lot of garbage to find what's actually good value. Some sellers will likely see writing on the wall and adjust their prices accordingly. Others, on the other hand, are probably going to be stubborn and stick to their low cap rate expectations, and you don't want any part of that. The key is to find deals that will still be good even if cap rates rise and even if NOI stays relatively flat. I personally don't think NOI is going to go deeply negative, but I think in a worst case scenario, it could be pretty flat over the next couple of years and cap rates are still going to be good. So my goal when I look and invest in multifamily real estate is to find things that even if those worst case scenarios still come true, my deal still works. So I want to show you something that I created. It's called a sensitivity analysis. I didn't invent this, but I made this chart. Sensitivity analysis basically shows different exit scenarios for deals. And what this shows is IRR, an internal rate of return, which is my preferred metric when I invest in multifamily assets. And what it shows is different cap rates that might be market value when you go to sell and different NOIs based on where they are today. So like all the way on the left here, you could say, what happens if my NOI drops to 70% of what it is now and cap rates go up to 6.15% in my market? I would get a 6.3% IRR. That's actually not that bad, right? That's the worst case scenario, and I'd still earn a 6.3% IRR. That's still better than a lot of different assets classes out there. So I found this deal really good. Meanwhile, if I hit my projections, which would be 100% on the NOI column, and then on the 5.65 row, then I'd get an IRR of 16.5%, which would be phenomenal. And obviously there is still upside. So I encourage you, even though the asset prices are falling, to do this type of analysis where you say to yourself, even if these projections come true or cap rates go up and NOI go and it stays flat, does my deal still make sense? To me, this is the only way to invest, right? You have to acknowledge that there are adverse variables in the market right now. But again, there are good deals. So you have to be able to square those two things and say, even if these adverse variables impact my deal, will they still work? That's what I'm doing, and it's what I recommend you do as well. I hope this update makes sense to you guys. Just as a brief summary, again, multifamily assets have dropped about 13% nationally from last year to this year, and CoStar, which is a very big reputable data company, is expecting that we're going to see declines for the next 12 to 18 months, probably around another 10%. So this is something you really want to pay attention to if you're in this space or interested in getting into this space. There will probably be good deals, but you do need to protect yourself from future value declines. Hope this video was helpful to you guys. Thank you guys so much for watching. I'm Dave Meyer for BiggerPockets, and I will see you all next week.